In chemistry, a reaction only happens when the conditions are right. It's no different in real estate. Welcome to the Alkaline Reaction, a podcast from Alkaline Advisors, where we break down the deals, partners, and capital structures that turn opportunities into outcomes. I'm Spencer Carenti, and today's reaction: hidden mechanics behind financing. Most commercial real estate deals don't fail because of a single dramatic event. They fail through a gradual loss of flexibility. There's usually no sudden collapse in rent, no obvious mistake, and no single headline moment. Instead, liquidity tightens, decision-making slows, and options quietly disappear. When you look back, the problem is often not the real estate itself, but the way the deal was financed. Today, we'll dig deeper into 4 parts of real estate capital structures that tend to determine outcomes when property-level performance softens. These are areas that rarely show up in underwriting models, but can drive real-world behaviors. Those 4 areas are: first, intercreditor agreements; second, cash management and springing cash traps; third, recourse carve-outs or bad boy guarantees; and fourth, loan extension conditions. Let's start with intercreditor agreements. Most investors think about the capital stack in terms of priority: senior debt at the top, mezzanine in the middle, equity at the bottom. But priority of payment is only part of the story. What actually matters in a downside scenario is control, and control is defined almost entirely by the intercreditor agreement. Intercreditor agreements govern who can act, when they can act, and under what conditions. In many mezzanine structures, the mezz lender is subject to a standstill period if the senior loan defaults. That standstill can be 90 days, 120 days, or even longer. During that period, the mezz lender is prohibited from exercising remedies, including foreclosing on their pledge of equity. Meanwhile, interest continues to accrue at both the senior and mezz levels. Default interest may kick in, fees accumulate, and the senior lender controls the pace of enforcement. By the time the standstill expires, the senior lender may already be deep into a foreclosure or deed in lieu process. Here's a practical example. A property experiences declining NOI and breaches a senior loan covenant. The mezz lender sees the issue early and would prefer to step in, fund reserves, or take control before value erodes further. But the intercreditor agreement prevents action. By the time the mezz lender is legally allowed to act, the senior lender may have already accelerated the loan and positioned themselves to take title. In that situation, mezzanine debt's downside protection exists on paper, but not in execution. Next, let's talk about cash management. Most institutional senior loans today include some form of cash management, either hard lock boxes or springing mechanisms. That's standard. The part that's often underestimated is how sensitive those mechanisms can be and how quickly they change the economics of ownership. Springing cash traps are typically tied to financial covenants like debt service coverage ratio, debt yield, or sometimes occupancy thresholds. Importantly, those triggers are often set close to underwritten levels. A DSCR, slipping from 1.3 to 1.1, may not signal true distress, but it can be enough to trip a cash trap. Once triggered, all property cash flow is swept into lender-controlled accounts. Operating expenses may still be paid, but excess cash is no longer freely available to the borrower. Distributions stop. Capital expenditures may require lender approval. Leasing commissions and tenant improvement packages may be capped or delayed. The issue is timing. Cash traps often activate before an asset is fundamentally broken. A temporary leasing gap, a short-term rollover issue, or higher interest expense can restrict liquidity at precisely the moment flexibility is needed most. Sponsors may respond by deferring maintenance, delaying leasing decisions, or pulling back on capital investment, which can further weaken performance. In that way, cash management provisions can convert a manageable operational issue into a prolonged structural problem. Third, let's move to recourse carve-outs. Recourse carve-outs are commonly described as protection against bad behavior, fraud, misappropriation of funds, or intentional misconduct. While those provisions still exist, modern loan documents have expanded carve-outs significantly. Today, carve-outs often include technical triggers, such as violations of single-purpose entity requirements, unauthorized transfers of ownership interests, failure to comply with cash management provisions, or even certain indemnity obligations. In some cases, the mere filing of a bankruptcy by an affiliate can trigger partial or full recourse. In stressed situations, lenders may also use carve-outs as leverage rather than as a last resort. For example, if a sponsor is negotiating a forbearance or modification, the lender may assert that a carve-out has been triggered and use that exposure to influence terms. At that point, the risk profile of the deal changes materially. What was modeled as non-recourse becomes sponsor-level exposure. A practical takeaway here is that non-recourse does not mean no risk to the sponsor. It means risk that is conditional on compliance with a complex set of legal and operational requirements. In downturns, those conditions are tested more frequently and technical violations become more consequential. And lastly, let's discuss loan extension conditions. Loan extensions are almost always modeled as straightforward options. Underwriting often assumes that if the market is soft at maturity, the borrower will simply exercise an extension and buy time. In reality, extensions are contractual options with conditions, not guarantees. Extension conditions often include updated appraisals, showing a minimum LTV, minimum DSCR, fresh equity contributions, replacement reserves, extension fees, and sometimes principal paydowns. Importantly, these tests are usually applied at the time of extension, not at origination. The problem is that the need for an extension usually coincides with declining values or reduced cash flow. That's when updated appraisals come in lower and coverage tests are hardest to meet. A sponsor may discover that the extension they modeled is unavailable without injecting new capital that may not be readily available or economically rational to deploy. In those situations, what looked like flexibility becomes a hard maturity. Leverage shifts back to the lender, and negotiations happen from a weaker position. An extension option only has real value if it remains executable in a downside case, not just under base case assumptions. If there's a common thread across all four of these areas, it's that a significant portion of commercial real estate risk lives outside of traditional underwriting models. It's not captured in rent growth assumptions or exit cap rates. It's embedded in legal and structural provisions that govern control, liquidity, and recourse when performance softens. Intercreditor agreements determine who controls the outcome. Cash management determines whether liquidity supports recovery or accelerates decline. Recourse carve-outs determine whether risk stays with the asset or migrates to the sponsor. And extension conditions determine whether time is truly available when it's needed most. Understanding these mechanics doesn't eliminate risk, but it allows for a more realistic assessment of it. And in commercial real estate, realistic assessment is often the difference between navigating a downturn or being forced into one. That's today's reaction. If you found this episode helpful, please subscribe and join us next time as we continue breaking down the commercial real estate industry. I'm Spencer Carenti, and thank you for your time.